Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're very, very well, that you had a really super bank holiday weekend. What a treat to have sunshine every single day. Not a raindrop in sight, well, not where I live anyway. I hope it was the same for you and you're very, very good. Now, this week, what we've got for you, we've got lots of really good stuff. I say good, we've got lots of very important stuff to cover off with you in relation to what's been happening with interest rates. So for those of you who watched this video last week, we were talking about the fact that swap rates were really starting to increase at quite a pace. And actually, once I recorded the video, the next day, so on the Wednesday, things kind of went into a bit of meltdown, if I'm really honest with you. So we're going to be talking about what's been happening there, where we are now, and how things are looking going forwards. We're also going to talk a bit about housing market data that's been released. We're going to talk about the buy-to-let barometer, which is essentially a piece of research that the mortgage works do once a quarter on landlords to find out how they're feeling and what their kinds of plans are for the future. Always really interesting reading. I think as landlords, it's always nice to know how the landlords feel because, you know, it can be quite isolated. And then we're actually going to end this week, beyond all of that, on a high, because I'm going to be sharing with you the latest news on my buy-to-let property and the journey that I'm on to be able to evict, for want of a better word, my non-paying tenants. So I have a hot off the press update, which I only received in the last half an hour, that I'm going to be sharing with you as well. Okay, so it has been one of those weeks, which we seem to see quite a lot of at the moment, actually. I feel like maybe this is just our new normal. But what we saw middle of last week when we recorded the video is we were saying that essentially swap rates were starting to tick up very, very quickly, that we were starting to see lenders pull products and withdraw them and bring on higher new rates. And then things really went into overdrive. So what we've actually seen is that swap rates have gone up to sort of circa 4.5, 4.6%. Now, they were sitting at between 3.8 and on sort of bad days, just over 4%, and now up to 4.5, 4.6, that kind of mark. So it's not been a great week in that regard. And what we've seen is essentially lots of lenders withdrawing their mortgage products because the capital markets, essentially where lenders get their money from to lend it back out to you as a borrower, the pricing has been so volatile, the lenders just don't really know how to price deals. So I think a lot of them are kind of just waiting to see the dust, how the dust settles. So first of all, let's just talk about swap rates and what's going on. So as of noon on Tuesday, 5-year swap rates were at 4.561. Now, 1 month ago, they were at 3.882, and 1 year ago, they were at 2.119. So let's go now across the different length of swap rates in terms of 2-year fixed, 5-year fixed, that kind of thing. So at the moment, a 2-year swap is at 5.120%, as I mentioned. 5 years, 4.561, 7 years, 4.335, and 10 years, 4.180%. So things are markedly higher than they were this time last week and much higher than they were a month ago. Now, what's driving this? So the latest thing that's really kind of set the markets into, well, to make them very, very nervous, there's a couple of things going on actually in the background. So the first thing is, the inflation figures that came out in the last week, so everyone was really, really happy. The inflation had reduced from 10.1% in March down to 8.7%. So that was really positive. However, core inflation, which excludes the more volatile costings, so energy, food, alcohol and tobacco, has actually increased up from 6.2% in March to 6.8% in April, which is the highest rate since 1992. So actually, whilst it looks like inflation is under control, core inflation is not, and that's really important. So that's made the money markets very, very nervous. Now, on the back of that, there is further calls for the Bank of England, or schools of thought, I should say, for the Bank of England to continue increasing base rate. And the current kind of pundits' predictions are that we may expect base rate to go up as high as 5.5% now. Now, the other thing that's driving swap rates at the moment is concerns about the situation in the USA and their debt ceiling. So you may or may not sort of watch this on the news, but essentially what's happened is that in the US, they were approaching their debt ceiling levels, so essentially their credit limit that they can have, which is currently $31.4 trillion, so huge amounts of money. But what happens is the US has a kind of maximum level of debt they can get into, and if they're going to surpass that, it needs to be agreed. Now, there's been some backwards and forwards between the Republicans and the Democrats trying to get this sorted out, and we're approaching the deadline where essentially on the 1st of June, if this debt ceiling hadn't been increased, the US would potentially default on all of its commitments, which would be globally a really, really bad thing. Now, thankfully, over the weekend, a deal was finalised between the Republicans and the Democrats to actually suspend the debt ceiling until November 2024. So that gives them a large amount of time. And within these agreements, there was various things set up which were going to be kind of worked on to try and drive down the US debt position. Now, although the deal has been finalised, it now needs to be voted on, and that's going to start later on this week. So at the moment, we're in this kind of limbo position where there's a deal that's been kind of prepared and proposed, but now it needs to be voted on. So the market's going to be feeling very nervous about that as well, because if this doesn't get signed off, if it doesn't get agreed, then there's going to be a real sort of problem. So I think the reality is that for the next week or so, while this is still bubbling on, the markets are going to be still very, very nervous, and we're not going to see much change in terms of swap rates. So that's kind of the background story to what's been going on. Now, in terms of how this is fed through to the lending market, so we have seen, I mean, a plethora would not be an over-exaggeration of lender changes. And I'm just going to kind of read these through for you so you can kind of get a gist of what's been going. But essentially what's happened is lenders have done one of two things. Either they have withdrawn and repriced upwards because they're going to have to because their cost of funds has gone up, or the other thing that will have happened is that some lenders have said, actually, we don't like all this volatility, we're going to withdraw our products and we're going to not release anything else until things settle down a bit. So lenders sit in one of two camps on this. So in terms of lenders who have simply withdrawn products and haven't bought anything out yet to replace these, so the Coventry have withdrawn most of their fixed rates, Aldermore have withdrawn all of their products, Hampshire Trust, TML, the mortgage lender, Capital Home Loans, Fleet Mortgages and Paragon have also withdrawn all products at the moment. So they have no fixed rates available. Some of them have trackers or discounted rates, but no fixed rate pricing. Now, please don't read this as a permanent sort of state of being. Things are going to change. Lenders will come back out of pricing, but they're just waiting for things to settle down. I think as a lender, you know, if you're not desperate to be lending money at all, then actually it's probably, you know, as wise to say, do you know what, for the time being, we're just going to hold off, let things settle down, let our cost of funds kind of reach a kind of point where it's relatively stable, and then we'll come back out with pricing. So I don't think any of these lenders are out of the market permanently by any stretch of the imagination. They're just taking a pause. Now, we've also seen Interbay, Kent Reliance, Precise Mortgages and Kensington withdraw their special edition products. So what they've got is a core set of products and then some special edition products or limited edition. And as those of you who watch this video frequently, you will know this is where the lenders bring out a slightly more competitive rate than the one they're offering as a matter of course, which will be available on a limited basis. So it tends to be more competitive than their standard product set. These guys have withdrawn all of those rates as well. Now, the good news is that despite all of this, there are lots of lenders who have said, actually, do you know what? Our cost of funds has gone up, so what? We'll just increase our pricing to reflect that. So we've seen Virgin increase their rates. Their pricing now starts from 4.27%, which doesn't actually sound that bad, does it? So their rate pricing has increased by, broadly speaking, circa 0.12%. So nothing too crazy there. Now, I think it's just worth noting that not all lenders are wholly reliant on the capital markets for their funding. Some will do a mixture of balance sheet lending, i.e. essentially savers money, and then the capital markets. So some lenders, particularly the clearing banks, where you kind of would save with them, they have a spread of risk in terms of where their money comes from. So they're able to absorb these spikes in pricing probably a little bit better than those lenders who are 100% exposed to it. So just in case you're wondering why people like Virgin have only made a marginal increase. Now, we've also seen Bank of Ireland increase their rates, Shawbrook have also increased their rates. The Mortgage Works have increased theirs, so their 2-year pricing is now from 3.74, 5-year pricing from 4.24. We've seen Landbay put their rates up, so they have rates from 4.49% with a 7% fee or 5.29 with a 3% fee, just to give you a slightly more balanced view on things. Keystone rates have gone up again, not all of them, just some of them, pricing here from 4.54 on 2-year money. Foundation have pulled most of their rates and increased the ones that are remaining, so their pricing is now from 6.69%. And we've seen MT Finance increase their rates by 0.15% as well. We've seen the Buckinghamshire increase their rates by 0.25%, Accord have increased rates by up to 0.7%. LendInvest withdrew all of their fixed rates, but then relaunched them again today, and their pricing 5 years, and this is quite interesting, 5 years from 6.29, 7 years from 6.19, and 10 years from 6.14. And if you cast your mind back to the beginning, when we talked about the various cost of funds, the various swap rates on the markets, you'll remember that 2-year was the most expensive, and then it kind of went down. So LendInvest is very much just reflecting that. Now, in terms of our kind of longer term view on things, Looking at the swap rates, the fact that 2-year swaps are still more expensive than 3 years and 5 years and so on, it really does indicate the markets are still very much expecting that interest rates are going to peak and then come down again. But I think what we're seeing now is a kind of prolongment of this heightened interest rate period that we're in. And as I mentioned earlier, there is an expectation that base rate will actually have to go up a couple more times at least, just to really try and slow down inflation. So I think the message is very much this: don't panic. I do think there's going to be more rates come out. I think once the situation in the US calms down, things should ease a little bit. But really it's just one of those periods of time where I think actually probably a good thing to do if you're looking for a mortgage rate at the moment is try and lock in on something with a lender. And then if before completion, most lenders allow you to do this, if their rates come down, you can then move on to one of the other products, which will be a lower interest rate during that time. Once you've completed, you're kind of locked in, but any time up until that point, most lenders will allow you to move on to the lower rate, which will be better for you. They may charge you a small fee. Generally speaking, it's like £150 if they charge at all, but most lenders don't charge you anything. So I think that's a really good way of kind of protecting your position. But like I say, the overarching message here is don't panic. We're kind of just going through a very big wobble at the moment. I do think things are going to kind of calm down again. Hopefully by next week we'll have some better news. But I do remember saying this to you last week as well, so just watch this space. Okay, now moving on to slightly more positive news, I hope. Zoopla have released some data with regards to the housing market, which shows that the agreed sales have reached their highest point this year, and this is despite weaker demand than a year ago. The number of sales has also gone up 11% on the 5-year average as buyer confidence has continued to improve. Now, interestingly, Zoopla noted there were distinct differences in the strength of demand and the number of sales across the country. Demand and sales went above the 5-year average in Scotland, the North East and London, which have been the best performing regions over the last 4 weeks. By contrast, demand for housing in regions in southern England was lagging behind, and Zoopla said that this has been added to affordability changes. Now, one of the things that they go on to say, which I found quite interesting, is that a chap called Mr. Donnell, who works at Zoopla, has said that sellers shouldn't get carried away by more positive data in the housing market and need to price their homes realistically if they're serious about moving home in 2023. He said that home buyers remain price sensitive with one eye firmly on the outlook for the economy, the cost of living and the trajectory of mortgage rates, which appeared likely to edge higher in the coming weeks. So I think really what we're seeing here is a kind of reinforcement that the housing market is actually remaining really robust. However, it's performing better in some regions than others, and those areas which are most greatly affected by the cost of living and affordability changes in terms of mortgage lending, and particularly this is the south of England, my neck of the woods, are finding things more difficult than maybe other areas. But I think the positive news here is very much that actually the housing market does continue to hold firm. Okay, now how are your landlord peers feeling at the moment? So the Mortgage Works does what it calls its buy-to-let barometer, where it goes out and reaches out to thousands of landlords and asks them various questions about their plans and how they're feeling. Really, really useful information. Now, one thing just to keep in mind is this barometer is measuring Q1 2023, so essentially January to March inclusive. Okay, so some of the questions they were asked. So first of all, they asked how many landlords were planning to buy a property in the next 12 months and how many are planning to sell. So 10% are planning to buy a property in the next 12 months, and that's up 1 percentage point from Q4 last year. 33% are likely to sell a property in the next 12 months, which is up 3% from Q4 last year. So now essentially 3 times more landlords are planning to sell rather than buy, which is actually quite unsettling news, particularly when we consider the rental market housing crisis that we're facing at the moment. So we could just do with not lots of landlords leaving the market. However, as we've covered off in many times, there's lots of reasons why landlords are feeling that this is the best route for them now. Now, the other thing that is quite interesting is they asked landlords about their how they're feeling upbeat about the prospects for capital gains and rental yields. And actually, both of these have also dropped off. Now, capital gains, so last year, 50% of landlords were feeling positive about the prospect of capital gains in the rental market. This has dropped down now to 21%. Now, I think that is actually really understandable. If you're thinking about property prices and you're hearing all over the place that they're coming down, then of course there is an expectation that your capital gains may well not be as great as you'd have hoped. It may even go negative for a very short period of time. So I think that was understandable. The one that actually I found more surprising is that the number of landlords feeling positive about their rental yields has dropped down to 42% from 56%. Now, rental yields are simply a measure of rent versus property value. So it's got nothing to do with mortgage costs in there. So actually I was quite surprised that given we're seeing a flattening of house prices, even a reduction, so people are worried about their capital gains, but likewise we're seeing rents increasing across the whole country. The fact that less landlords are feeling positive about the rental yields I found slightly strange. Compounded this by the fact that 67% of landlords who replied to this survey are reporting increasing tenant demand over the last 3 months. So a little bit of a random one there, but I think the message is very much actually landlords are probably feeling quite vulnerable and exposed and quite disenfranchised at the moment. And I think this is going to be an accumulation of things. This is not just about mortgages. It's not just about tax. It's not just about legislation. It's not just the rental reform bill. It's a kind of amalgamation of all of these things. So yeah, I think actually I felt quite saddened to read that report this week, but hopefully this is just a moment in time. Actually, you know, things are kind of bounced around with landlord sentiment. I'm hoping that actually, as we get to the end of Q2 in 2023, hopefully you guys will be feeling slightly more chipper about being a landlord. And lastly, on the subject of being more chipper about being a landlord, I have finally just today received my bailiff date for the eviction of my tenants, which is going to be happening on the 12th of June. So actually, that's been relatively quick. I think I would have been waiting in total about maybe 4 or 5 weeks from the point where the bailiff was instructed. So relatively fast. I know these things can go on for months for some people, so I'm feeling incredibly fortunate. So what happens now? So on the 12th of June, thankfully my estate agent is going to do this. I don't have to go through it because I just don't think I could bear it. They're going to turn up to the property 15 minutes before the appointment date with a locksmith in tow. The bailiff's going to turn up, enter the property, and then they're going to remain there until such time the tenants vacate, the locks get changed, and we all kind of move on. So fingers crossed on the day it goes without any hitches, and that the tenants are able to get hold of some accommodation from the housing association. I believe that's what they've been waiting for all this time, is the eviction letter, so they can apply for that. So fingers crossed they're going to be moving on to somewhere else and they're going to be okay. And then after this, we move on to the next phase of the joy that is getting my tenant and my buy-to-let property back, of what state have they left my property in, which doesn't even bear thinking about. Hopefully they've left it in a good condition. But the second thing is actually pursuing now for the rent that's owed to me. So off the top of my head, I think I'm owed in total of unpaid rents, court fees and all that kind of stuff. It's about £20,000. It's a huge amount of money, not the kind of money that I'm willing to kind of just kiss goodbye. So my tenant had a guarantor. My tenants went into breathing space. They clearly don't have any money. So I think that my sister's advice was going to be that we would pursue the guarantor via the courts. So I'm going to be keeping you posted on how this works. Now, there is a chance the guarantor is going to say, okay, they finally vacated. I know what the final bill is. Would you settle on this amount of money? I'm hoping there's going to be some sort of negotiation in there. But there's a very strong chance that actually we're going to have to pursue them via the courts. So I will be taking you on this journey with me. I'm so sorry it's not a more cheerful video this week. Obviously the news with the interest rates is really worrying, and actually it's really unfortunate as well, because things were kind of getting onto a much more even keel after the kind of trauma of the mini budget and all the things that kind of came out of that. So I am genuinely hoping and expecting this to be a kind of moment in time that will pass over the next few weeks. But one thing is certainly for sure, in the mortgage market, things can be a little bit unpredictable. So we will keep you posted. That's all we can really do. But if you do have any questions, or if you just want to have a chat about how you're sort of worrying about things, and if there's any possibilities of, you know, trying to kind of get you on a better footing, please just give us a call, 0345 345 6788, or have a look at our website. Fingers crossed for a better update next week, but until then, just look after yourselves and let's just try and make the most of the good weather. That's something nice going on in the background, at least for now. See you same time next week.